In this video, we're going to continue with the basic tax research, but we're going to focus on application and analysis. So in the previous videos, we focused on issue identification, and that's going to be very important. So really, the end piece when it comes to tax research is the memorandum or the memo. So this is the format of a memo, and the facts, these won't be here. So let me take this out. So what you're going to see, you're going to have facts, issue, analysis, and conclusion. Now this is the format. Those are the four parts. The analysis section, I have these rules here, which I'll talk about how I got those rules in a moment, but that will also be empty. So the facts section, that's where we have the facts, and here assume that the partner has sent you an email with these facts. But usually what happens is a partner will come to you with a specific set of facts, and you're going to shorten those facts to what is the most important and essential in making your decision when going through the tax law. It's all about being concise. You're giving this to a senior partner, and the senior partner does not have much time to be able to look through everything. So you need to make this as concise as possible. Well, you're the junior associate, so this is the to, from, date, and subject. So we got this fact pattern. Boss Ross recently was in a serious automobile accident that was his fault. As part of Boss's physical therapy program, his medical care provider and physician has recommended that he do swim therapy in a pool 3 times a day for the next several years. This is the best type of therapy for his injury. Boss lives in a very rural area, and the closest non-private swimming pool he can use is over an hour away. He cannot travel for long periods of time due to his injury. Boss is going to purchase a below-ground pool at his house for physical therapy because, again, the doctor recommended it. He does have family that will likely use the pool as well. I mean, of course, if you have this pool, why not allow other people to use it, right? It's a very large purchase. Boss is spending $80,000 for a luxury pool, so that's what he's going to spend. That is altogether one big pool, but it has a special lane on the side meant for his physical therapy. It's meant specifically for his physical therapy. So that's the facts, okay? So again, if you have some facts from a client, you're going to summarize the facts in this section. So the issue is going to be specifically what issue you're addressing in the memorandum. Analysis, this is the key. This is the heart of the memo. This is where you apply the rules to the facts and you come up with your logical reasoning. And conclusion is looking at the issue, how should you conclude in terms of a tax decision? So in a previous video, and if you don't have access to the video, it's fine, we went through checkpoint. And we identified how to research this specific fact pattern and how to come across various rules of law that might be applicable. And we came up with these rules. We came up with Code Section 262, 213, 263, Regulation Section 1.213-1, the Ferris First Commissioner 7th Circuit case, and a private letter ruling from 1982. So the way that I got there is we use the fact pattern to kind of identify what's the best way to keyword search. Now we start with a primary search, which remember primary search involves the code sections, the regulations, certain cases, certain case law, right? Which for that decision, since we don't really know which jurisdiction we're in, we just searched all cases, and revenue rulings and rev procs, all right? Now, I say that we use a primary source, which those are primary sources, but it's also valuable to have some secondary sources, especially things like private letter rulings, because a lot of times private letter rulings will have more specific fact pattern or facts that are in a very fact-sensitive area. So when looking through this little fact pattern, we identified some very unique items. The first thing that might jump out at you is swimming. So a swimming pool. So we searched swimming pool, and in checkpoint through the new intuitive search, when we typed in swimming pool, we saw a whole host of things, kind of like when you do Google or another search engine, you see all different types of things that are very common to be searched. We saw swimming pool expense, swimming pool deduction, we saw swimming pool medical expense, and swimming pool medical deduction. So we said, this swimming pool medical deduction, that seems like a great place to start because here we have a medical care provider and Boss is purchasing this pool for the main reason of physical therapy, which he has to do 3 times a day for the next several years. So when we search the phrase swimming pool medical expense deduction or medical deduction, either one, we didn't find any code sections that came up, but we did find some cases and private letter rulings, and we found a private letter ruling that was pretty much on point, and that was private letter ruling 82-21128, and I'm going to pull that up right now so we can take a look at that. And in that private letter ruling, we saw a specific instance, and this is just a summary. Doctor advised taxpayer to install heated swimming pool for son's exercise program. Son who has spinal cord defect has paralysis in lower limbs. Ruled, cost of swimming pool is deductible, medical expense to the extent it doesn't exceed minimum reasonable cost of functionally adequate facility and to extent that such minimum reasonable cost exceeds increase in value of home because of insulation. So this is very similar issue than what we're looking at. Now, it references Code Section 213. That's very, very good. And when we went there, we saw that by pulling up Code Section 213, which I have here, we see that it allows a deduction for medical, dental, etc. expenses. There shall be allowed as a deduction paid during a taxable year for medical care provider to the extent that such expenses exceed 10%. So what is medical care? If we go below, and indeed there's definitions, the term medical care means amounts paid for diagnosis, cure, mitigation, treatment. That treatment, that seems like that's very much what Boss is doing with the physical therapy. So we go back to the private letter ruling. Okay? We go back to the private letter ruling, and when we continue reading, it's great. We go through more facts, and we'll look at these facts later on, but it actually gives us a really good framework for how to address the issue and how to actually search through this. It's great. Even if this private letter ruling isn't exactly close to what we need, it has the same issues, it still gives us a framework. So Section 262 of the Internal Revenue Code prohibits deduction of personal living or family expenses unless expressly allowed under some other code section. So that's really a good place to start. Whenever you're doing research, okay, it seems like the issue here, we have our facts, we want to identify what the issue is. So I'm going to write this out. So the issue is, can Boss deduct the cost of the swimming pool as a medical expense deduction under Code Section 213. So notice this is very descriptive. We isolated the swimming pool as a medical expense, which we saw that in the language of Section 213, right? We saw that specific language, medical care, the main provision, the allowance of the deduction. And if you actually even want to get more specific and you want to be more technical, because remember, this is an intro document. Can Boss deduct? Is Boss allowed a deduction? So allowed is actually the correct word. Is Boss allowed a deduction for the cost of the swimming pool as a medical expense deduction under Code Section 213? Okay? That really keeps it technical. Okay? You want to keep it technical but as concise as possible. So the issue should be stated as clearly as possible, but also as technical as possible. Notice how we changed that word around to for allow. So is Boss allowed a deduction for the cost of the swimming pool as a medical expense deduction? So we're narrowing it down here, not just, is Boss allowed a deduction? Well, that's very vague because it could be tons of deductions. Could be a business deduction, could be a loss deduction, right? This is for a medical expense deduction under Code Section 213. So see how we do that? So that's the issue. That's how you articulate an issue as clear as possible. That's a good little summary on how to articulate an issue. Okay, so now that we have our issue, let's focus on the important part, again, the heart of your memo, the analysis. And that's really going to be where you spend most of your time formulating your thoughts, but you have to do it in a way, again, that's very concise, that's very direct, and it gets to the heart of all the issues that are related to the specific fact pattern that's in front of you. So one thing you should always keep in mind is that when you're doing a memo, it's very important, again, to use the skills that you've learned in the previous videos and readings with regard to the levels of authority. As you recall, the code section or the Internal Revenue Code, that's the most important. So you should always start your analysis by citing a code section. There's a few rare exceptions to this, and this includes, if you recall, our 5 questions, right, of how to 5 questions you can always ask in any income tax issue, which are what amount of income, what amount of deduction or credit, when do you have it, who, and what is the character. That who question, that there's no code sections that deal with assignment of income really. If there is, it's within a specific issue. The general principles of what we call assignment of income or the who question are actually developed through Supreme Court jurisprudence or law. So in that case, you would actually start with citing a Supreme Court rule of law or proposition. Here, in this issue, we have no issue of who. It's all about what amount can be deducted and outflow, right? So again, I want to bring a few things to your attention. You've learned about that 5 questions, the 5 questions you should always ask. If you ever have an issue in tax, always start by asking those. Here, I've already gone through and identified that we learned quickly through our research that it was a deduction that was at issue with this respective fact pattern. So we articulated that the issue here is, in terms of the 5 questions, is what amount is the deduction? Okay, so that helps you because it saves you plenty of time, saves you lots of time. Because you have to think about if you're working at a accounting firm or a law firm and you are a junior associate sending this to a partner, you have a very limited time and budget to work on this. Less than an hour probably to figure this out, okay? So we found that private letter ruling and it pointed to a bunch of code sections. Now, a good way to, if you don't know about an area of law, a good way to start is by looking at something like a secondary source like private letter ruling or a treatise or whatnot. And in our basic tax research through Checkpoint, we have the very basic package, so we don't really have any treatises or whatnot to use. So we use like a private letter ruling with a secondary source to actually guide us through the law. So let's take a look again at that private letter ruling. And it starts out, the first code section is that certain deductions related to personal, living, or family expenses are not allowed. So let's go to that code section, okay? So usually, you can actually click on this if you're in Checkpoint. I've already done that for you. I've brought this up. So section 262A says, except as otherwise provided in this chapter. So that means there's an exception or possible exceptions. No deduction shall be allowed for personal, living, or family expenses. So this is really important because the issue that involving boss is definitely a personal, living, or family. You might recall if you've learned about deductions that there's really 3 different classes of deductions. And if you didn't know this, you could have found this through doing research. There's business, there's investment, and there's personal, living, or family. Well, this is definitely personal. This is not dealing with boss's business or investment activity, right? It's very clear it's personal. Even though it involves, his well-being and whatnot to do business, it's actually involving his personal, physical aspects, okay? So what I recommend doing is you want to start off by citing this, and you want to cite this proposition. So it's one thing in tax, you always hear, or when you're doing a paper or whatnot, do not plagiarize. As long as you cite sources, then and you make sure that it's a clear, concise, then you can do, as long as you cite it properly, you can do whatever you need to do. So let's start off by citing that what we just we have here. No deduction shall be allowed for personal, living, or family expenses. So we can start off there, and you might want to make it a little bit better. No deduction is allowed for personal expenses unless otherwise provided. So this is a general rule. So what I like to do is I always like to say the general rule for personal expenses is that no deduction is allowed unless there is a specific exception. And we can cite. So this is one thing that I want to be clear on. how to cite proper sources, because it's one thing, you've used APA format or different formats, your English classes or whatnot. When it comes to law, you have to cite a certain way. And there's this thing called the Blue Book. I'm using a more simple approach to the Blue Book, but it's very similar. So I have a little guide here that might help you, tax citation format, and I recommend looking at the Blue Book because it's actually more official, but this just gives you a little guide. So we're looking for a code section. It says section 101, that's an example. We have, administrative, judicial, all that. So we'll use that here. And I've actually put the citations in the proper format. So these are already in proper format. So another thing is that we learned in previous videos that the code actually has sections, subsections, paragraphs, clauses, right? All that good stuff. We need to make sure that we're citing the right thing. We have 262A, the general rule. So let's make sure, because there's a B as well. So you want to be clear so that when the partner is looking at this, that they can go back and they can actually look at your sources, because they want to take a look at this as well. So this is how you cite. So we have the sentence, and then after the sentence we have a period, and then we put the citation with another period. So this is one thing I want to highlight here. I'm going to mention this a few times during this video. People think that memos are personal, are just for giving a black and white answer. No, it's possible that this fact pattern might not have all the facts that we need to answer the question. You can still use a memo to address those issues and bring attention to them. And I will tell you before we even go into this that I've created this fact pattern with that in mind. Okay. Now we're going to do as good as a job as we can to give what we think is the best answer. However, we need to draw attention to certain things. So keep that in mind when you're doing a memo. It's possible that the facts you have might be enough to answer the question, but many times they're not, and you have to go back to the client, ask for more information. But that doesn't mean you just put in the analysis, sorry, we don't have all the facts we need, done. You don't do that. You still have to make a good faith approach so that at least the partner has some idea of what to look at when they're asking the client certain questions. It's all about making yourself more valuable. So look, we have our first sentence. The general rule for personal expenses, right, and that's what Boss Ross is involved, is that no deduction is allowed unless there's a specific exception. So now, this is where it makes most logical sense to put down if there's an exception or not that may apply to Boss Ross. And we saw that when we looked at Code Section 213. Code Section 213 specifically allows a deduction for expenses related to medical care, okay, to the extent that they exceed 10% of adjusted gross income, and that's under 213A. So we want to highlight this. So I'm going to take off this highlighting so I can. I said highlight. We want to actually take this language. Let's just copy this language over and let's reformat it in a way that that's good to make it as concise as possible. So I paste this. Right, match destination. So there shall be allowed a deduction. The expenses paid during the year for not compensated for insurance. Do we have insurance here? Is Boss Ross getting insurance? No. So we can take that part out because even though it's important in general, it's not relevant to Boss Ross. We have nothing in the facts about insurance. Okay, Boss caused the accident. He's probably not getting insurance, just so you know. Okay, there shall be allowed a deduction. So maybe the next thing we want to say, one specific exception for personal expenses involves deductions related to medical care. We have to use those words, okay? So there shall be allowed a deduction, expenses paid during the taxable year for medical care of taxpayer, his spouse, or dependent. Okay? We're just dealing with boss, and the boss is the taxpayer. Now, we also want to make sure that we're clear to say about the, to the extent that such expenses exceed 10% of adjusted gross income. That's big. Anytime you have a limitation on something, you want to bring attention to that. So what I recommend doing is making that, I'd put that as actually part of the sentence. I know it's a little wordy, but you want to keep that together. You don't want to separate those. So now we can cite IRC 213A. Okay? So far we're going pretty good. Okay? So we got a general rule that no deductions allowed unless there's a specific exception for personal expenses. One specific exception for personal expenses involves deductions related to medical care to the extent that such expenses exceed 10% of adjusted gross income. Okay. Now, one thing I want to bring attention to is, and this is just something that I know, but it just shows you kind of how careful you have to be. You really have to ask, when did boss, when exactly is boss thinking about buying the pool, or boss is going to purchase? So this is in the future. Well, this is the law now. I will tell you that this 10% AGI limitation a few years ago was 7.5%, and years before that it was 3%. It's changed. It really does depend on the year at issue, okay? Because if you're in a certain year and a client comes to you about a respective situation, then it could be a different outcome than actually what is in the code. The code said 10% of adjusted gross income, but if it was 2 years ago, it might be 7.5%. If the taxpayer is a certain level, a certain age, that really does play. So you gotta be very careful. This is why practitioners in tax, they get paid money to deal with these issues, because there's so much complexity going on. But again, this is basic level, so we're going to assume that the 10% applies in this case as well. Okay, so now the next thing we want to do is we want to highlight what exactly medical care is. We want to highlight that. We saw that in our in section 213, in section 213E. Okay, medical care means amounts paid for the diagnosis, cure, mitigation, treatment, and that's the key, right? So what I think we should do is copy that over, and this is going to be D1 big A. Okay, so we need to make sure we cite that properly. And again, copy that over. I know but this makes your job as simple as possible. Okay, the term medical care means amounts paid for diagnosis, cure, mitigation. I would just use that language. That seems like good language to use here. Okay? And then we go ahead and we cite, right? IRC section 213D 1 big A. Okay? And you want to go back and you want to just make sure that that is the correct citation. You don't want to get the wrong citation. And that's what we have. We have D1A. So right there, we're really making good progress. So at this point, I think we cited a few rules of law and we kind of set the tone for our analysis. I think now we need to address some of the issues related to Boss Ross. So Boss Ross, and you can just use boss if you want. So let's just use boss. Boss is purchasing this swimming pool for physical therapy. Physical therapy is a form of treatment for Boss's automobile accident injury. Further, his physician has recommended that Boss do this specific physical therapy using the pool to improve his condition. And maybe this is something we need to know a little bit more facts of, because we're told that Boss Ross has to do this for the next several years. What exactly does the next several years mean? Is it just 1 or 2 years? This might be something that's relevant when we do when you look at our the additional issues that we have, or the additional sources we have. Okay, maybe this is just keeping Boss at a condition where he's not deteriorating. Okay, maybe he's getting worse, and by doing this 3 times a day, it's keeping him at a certain level. Okay, these are all things that you might want to bring to the attention of the of the partner. Now, at this point, I'm just going to leave this here. You can put extra parts in there about where to bring attention, but you're going to see there's going to be more issues we need to bring to attention later. So at that point, I think we've made it pretty clear that because we're told in the facts that boss is purchasing the pool for physical therapy, and he's even putting in a special lane that's only meant for the physical therapy, then I think that, it's pretty clear that the intentions are very solely that boss is doing this for physical therapy, which seems like that's treatment. And if you don't feel that's treatment, you could probably look additional for more case law, and you'll see that we have 2 cases that support that, which we don't really have to cite to them for treatment because they're going to be cited later on. Well, one's a case and one's a private letter ruling, okay? So we're starting off pretty good. Now, the next issue that we want to address is in the private letter ruling, we were brought to the attention that any expenditures, capital expenditures, are not deductible if they improve the value of the home. And a pool does just that, or the property, I should say. Okay? It says no deduction shall be allowed. So I think what I would do next is I would create the next paragraph. Okay? So I would indent this paragraph, and then I would start the next paragraph. And I would paste that language. No deduction shall be allowed. I would again state the general rule for capital expenditures, because that's the actual title of this code section 262. Capital expenditures. The general rule for capital expenditures that are paid out for new buildings or for permanent improvements or betterments made to increase the value or property of any property or estate is no deduction is allowed. Okay, so the general rule for capital expenditures that are paid out for new buildings or for permanent improvements or betterments made to increase the value of any property or estate is no deduction is allowed. And that's under IRC section 263. That's 263A1. Okay? We want to make sure that's clear. Now, one thing that when you read through the private letter ruling, which I mentioned, you find out in the regulations that certain expenditures are actually allowed. Okay, certain capital expenditures are allowed. So if you go through, this is the regulation 1.213-1, and I've highlighted the important parts. And we find here, capital expenditures are generally not deductible for federal income tax purposes. See section 263 and the regulations thereunder. However, an expenditure which otherwise qualifies as medical expense shall not be disqualified merely because it's capital expenditure. For purposes of section 213, this paragraph, a capital expenditure may qualify as medical expense if it has a primary purpose, the medical care. So we have to look at as defined in subdivisions 1 and 2 of this subparagraph. So that's a 2 above, and I've highlighted that. Of the taxpayer, spouse, or dependent. Thus, a capital expenditure which is related only to the sick person and not related to a permanent improvement or betterment of property, if otherwise qualifies as an expenditure for medical care, shall be deductible. For example, eyeglasses, seeing eye dog, artificial teeth and limbs, wheelchair, crutches, inclinator. The idea is that these things last longer than a year, so that makes them capital expenditures and not simply just like a repair or expense that's just in the during the year. Moreover, a capital expenditure for permanent improvement or betterment of property, which would not ordinarily be for the purpose of medical care, may nevertheless qualify as a medical expense to the extent that such expenditure exceeds the increase in the value of the related property if particular expenditure is related directly to medical care. So that seems like very likely here because they give an example of an elevator in a residence. So an elevator in the residence, yeah, maybe a physician, maybe maybe someone becomes elderly, they're immobile, they can't operate anymore, go upstairs. So they need an elevator in a residence. But that elevator might be used by other people in the family. Well, that's not only for that one person. You can't control that, right? The tax law can't have a policeman come in and say, oh, only this person, if you want to get a deduction, only the person that was injured can actually use it. No, that's going to be tough. So what the law says here is that certain capital expenditures that may have other benefits, outside of the medical care is provided or medical benefit that have other benefits. Well, what we're going to do is we're going to put a limitation on that. Okay, so this is really good, and they talk about how the increase in the value of the house due to this elevator, which they give an example of if the elevator costs $1,000 and the value of the home goes up by $700, then the difference of $300, the excess, is only considered to be deductible, and that's after taking into account you still take into account the 10% AGI issue. So that's really important here. So there's a few things I want to focus in on here. I think we should focus, I'm going to delete this so we can take some language. However, an expenditure, I would use this language. I would use this. So again, this just saves you time. So we just made that general rule for capital expenditures, and I would go ahead and paste that. Okay. However, an expenditure which otherwise qualifies as a medical expense under Section 213 shall not be disqualified merely because it is a capital expenditure. So I would use that language. Now, we have to find the correct citation, and regulations are really long, so we want to make sure that we do this properly. So we put Reg 1.213-1, and let's make sure that we have the right subsections and whatnot. So we are looking at E1, 3 little i's. E1, 3 little i's. And that's really important, again, because this regulation is very long. So that's going to be E1, 3 little i's. See how we did that? I know, you're like, wow, you can actually do this. As long as you cite that, then it's fine. It's a direct citation. It's saying that we pulled that right from there. And again, this is what you want to do because the more concise you make the language, and here this is really concisely written. There's some code sections and some provisions in the regulations where Congress writes something. It's just so wordy. You have to shorten it because the partner's not going to want to read a novel. You got to make it as concise as possible. And this one's actually really well written. So we also want to bring attention to the part we read about items that not only have a specific benefit but other benefit. So I believe that is here. Moreover, a capital expenditure for permanent improvement, which would not ordinarily be for the purpose of medical care, may nevertheless qualify as a medical expense to the extent that it exceeds the value of property. A particular expenditure is related directly to medical care. Okay? And you might even want to cite this regulation. I'm sorry, cite this regulation. This example. I would even use it. I would do all of this. I would do it. So let's go ahead and paste that because this is just so relevant. And we can actually use this example to bolster our argument. Moreover, a capital expenditure for permanent improvement. Okay, so let's just make this, do a little formatting here, right? You want to make your formatting right. Okay, this has got your name on it, and you don't want to, shortcut anything here. You want to make sure that you're following proper grammar and whatnot, and you're making sure that this is properly formatted. Okay, so the first part, moreover, a capital expenditure for permanent improvement or betterment of property which would not ordinarily be for the purpose of medical care may nevertheless qualify as a medical expense to the extent that the expenditure exceeds. I would rewrite this a little bit. It's a little confusing. So I would leave the moreover because that's a transition word. Capital expenditure for permanent improvement or betterment of property, which would not ordinarily be for the purpose of medical care. So what I would say there is, I would leave that. I would take out within the meaning of this paragraph because that it's going to be assumed that you've looked through that, and we have. And I'm going to talk about that in a moment. may nevertheless qualify as a medical expense to the extent that the expenditure exceeds the increased value of property if the particular expenditure is related directly to medical care. Okay, so I think that we can rearrange this a little bit just to make it a little bit more clear. Moreover, how about we take out the moreover and we put in if a capital expenditure related to a medical expense, so we can take out this for permanent improvement or betterment of property, has benefit to both for both the purposes of the medical care and non-medical care purposes, it can still qualify as a medical expense to the extent that the expenditure exceeds the increase in value of the property. Then I would go to this example. Whenever you have an example in the regulations like this one, I would actually highlight that. So let's go ahead and cite this, this proposition. That's from the regs, the same portion, right? In the regulations, I would actually say Treasury regulation section 1.312. There is an example where a taxpayer is advised by a physician to install an elevator in his residence so that the taxpayer's wife, who is afflicted with heart disease, will not be required to climb the stairs. If the cost of installing the elevator is $1,000 and the increase, how about we do this? Consider an example from the Treasury regulations. And then what I would do is I would put a colon here and I would block this off because this is definitely more than 50 words. So it's quite a long, and I would do a little short, I would do a little, I would indent this, okay? I know we're getting into a little bit more advanced stuff here. And I would italicize it because it's from the Treasury regulation. Taxpayer is advised by a physician to install an elevator in his residence so that the taxpayer's wife, who is afflicted with heart disease, will not be required to climb stairs. If the cost of installing the elevator is $1,000 and the increase in the value of the residence is determined to be only $700, the difference of $300, which is amount in excess of the value of enhancement, is deductible as a medical expense. So right there, I think that's boom. That's great right there. It's putting attention to, look, we found an example that's very similar to our fact pattern, to Boss's fact pattern involving, we're analogizing, right? This is what being, why the law is so important. You're analogizing an elevator to a pool, right? It's very similar. It's not exactly the same, but it's very similar. You have a physician recommending something, an elevator be installed because of some type of physical injury, okay? And you don't have to put in here, I know I mentioned in that last sentence that if a capital expenditure has benefit for both purposes of medical care and non-medical care purposes. Well, the partner can obviously see that if you put an elevator in a house, it's not only going to benefit the medical person, but it also gives them value. And if there's other people in the house, they can use the elevator. That's pretty clear. So you don't really have to cite that. So, or you don't have to mention that. Another thing is because we said consider an example from Treasury Regulation 1.231-1E 1.3 little I, you don't have to cite this. It's already cited there. Okay. So now what I would do is I would go back fix your formatting, right? And continue with this. Do a little bit of some analysis. So now we can talk about how boss's purchase of a swimming pool is a capital expenditure, okay? And the idea here is you're using technical language, so a tax partner probably knows what a capital expenditure versus an expense is, so they're going to have that in mind. I mean, if you want to go in detail, you can, but again, remember, you're sacrificing conciseness. So a swimming pool is a capital expenditure. That's pretty common, sense that it's going to last more than a year. Okay, if you want to put that, you're welcome to put that, but at the same time, you want to be as concise as possible. However, since it is related to a medical care, sorry, not 2A, since it's related to medical care, the special exception in the regulations can apply, sorry, let's be more clear. The special exception for capital expenditures in the medical expense regulation can apply to allow this deduction. Okay? So at this point, I think we brought attention to that, and we also want to make sure that we are clear we want to make sure that we're clear that this example involving an elevator is similar to boss's situation because the value of boss's home will increase. Okay, this is why, this is very important. You got to think like this. Will increase in value. We need to know, so this is, remember how I mentioned earlier you can bring attention to some stuff that you need to know? We need to know how much boss's property will increase in value because the difference, let's rewrite that. Because the amount attributable to increase in value cannot be deducted. So that's pretty clear. The amount, so if boss's, we're told that boss's pool is going to cost about $80,000, and let's say that home goes up by $60,000. Well, that $60,000 of that $80,000 cannot be deducted. So we're talking the difference of $20,000. All right. So now I want to look at there's one thing in the regulations that we saw that was really important that in that section 213 there. Okay, and we're really making progress here. We're getting closer and closer. But I want to go back to the regulations because this is something that's like, oh, you've just encountered something that you need to change from above. So we saw in here in the regulation that for purposes of 213, a capital expenditure made by a taxpayer may qualify if it has a primary purpose as defined in subdivisions 1 and 2. So if we're going to use this regulation, we got to go up to 2 above. Deductions for expenditures for medical care allowable under Section 213 will be confined strictly to expenses incurred primarily for the prevention or alleviation of a physical or mental defect or illness. Let's bring that language in because specifically that we're relying so heavily on this this paragraph, this three little I in Reg 1.213-1E 1, 3 little I, and it mentions that you have to have this, so we need to put that in there. It needs to be in there because if the partner reads that regulation and sees that and notices that we didn't even address that, that's a real issue. Okay, that's a real issue. So let's just go back to the paragraph we were writing before. Okay, the one up here. And I think right after this, the term medical care, I think we should insert this language that we just copied from that regulation. And let's just add that in there to bolster our argument that, look, we've gone through everything, okay? And that regulation is going to be, that's 1.213-1E1 two little i's. So we can copy over this citation and just change, right? You love this, right? It's like shortcuts. But hey, as long as you're citing the proper things, you're doing the correct thing, okay? So deductions for prevention or alleviation of a physical or mental defect or illness. Okay, so it's two little i's. Okay. So if we read that again, deductions for expenditures for medical care allowable under Section 213 will be confined strictly to expenses incurred primarily for the prevention or alleviation. So alleviation there, right? That seems like what that physical treatment is. That's even more language that can help. If let's say that this gets audited by the IRS and they bring attention to this issue, boss, and we have the language from the regulation there. Okay, boss is purchasing the pool. Physical therapy is a form of treatment, and we can also say an alleviation. Right? You like this, right? You like how we're keying in on certain language. Further, the physician has recommended that the boss do this specific physical therapy using the pool to improve his condition. Okay. So I would say after that, going back to this, therefore it seems as if the pool is a form of medical care. Okay. So now that we've talked about medical care, we've talked about capital expenditures. If you go through the private letter ruling, which I know I've kind of skipped around, I didn't actually go fully through the private letter ruling with you, but because just for the sake of time. But if you go through, you're going to notice a few other things. Okay, the courts have recognized the classification of an expense as medical or personal. They say it's a question of fact. And there's this case here, Ferris versus Commissioner, which actually this is probably the biggest case in there. It's a 7th Circuit case. There's not many Circuit Court of Appeals cases. There's no Supreme Court cases on swimming pools. I mean, that'd be an interesting Supreme Court case. But there's no. This is a Circuit Court of Appeals, so this is as good as you can get, okay, other than the Supreme Court. Now, we don't know if we're in the 7th Circuit, if we're here in Florida or the 11th Circuit, but if there's no circuit dealing in the 11th, if there's no circuit case in the 11th Circuit, then you can use the 7th Circuit, and it's very, very, very likely that it could be held as binding or at least very persuasive, okay? So we're going to take a look at this issue brought up right here. So in Ferris, we're told that the court held that the reasonable cost of a swimming pool and enclosure to the degree they are uncompensated for by increased value in taxpayers' residence are properly deductible as medical expense within the meaning of Section 213. However, this is where you get that principle, right? That's kind of what we've kind of figured out from the regulations, from the code, from the private letter ruling. However, the court further held that if a taxpayer makes a capital expenditure that would qualify as being for medical care, but does so in a manner creating additional costs attributable to such personal motivations as architectural or aesthetic compatibility with the related property, the additional costs incurred are not expenses for medical care and are not deductible. Okay? So this part right here, by the way, on the bottom, this is just the ruling for the private letter ruling, which now that we'll come back to the facts of the private letter ruling at the end because we can cite that to bolster our argument later, but we really want to focus on that case. Now let's go to that case. Okay, so what I'm getting from this is a little summary of what the IRS is saying in this private letter ruling. Private letter rulings are issued by the IRS. Taxpayers submit facts to the IRS. IRS rules on them before the actual taxpayer reports them as reportable transactions. Costs money, by the way, to do this. You can't just send it in. It costs quite a bit of money. Okay, so again, I want to summarize what the IRS is saying is about this court case. This is what their opinion is. They're saying that normally, that if a physician recommends or advises that a patient have a pool put in, and it seems like it's medical care, that you can deduct the cost of the pool to the extent of the differential in the value that, so beyond the increase in the value of the home. And that kind of makes sense economically if you think about it, right? You shouldn't be able to take a deduction for something you're getting some benefit for, right? That makes sense. Kind of like that no double tax benefit type of principle, but more economic. They're also saying, though, that if it's done in a way that is architecturally or aesthetic, so kind of like, I think what they're getting at here is like luxury, then you might not be able to take certain luxurious things, because the issue here is, okay, well, if you can take that, well, can we put in does it have to be like the cheapest pool possible? Can it be a nice pool of like, I don't know, like has like jets and, heated stuff and whatnot? And if we take a look at the case, let's take a look at this case. So this is the Ferris decision, and this is, again, the main decision in this area because, again, it's the highest level decision. And the facts here, so again, I've gone through this already, but again, it says Collins and Bonnie Ferris spent $194,000 and $194,660 in 1971. If you go and you look at the inflation adjuster, that's just over $1 million to construct a swimming pool addition to their home. That's just over $1 million in today's, and it could be it's a lot of money. Okay, it depends on when you're watching the video. When I'm recording this video, it's just over $1 million. Okay, could be even more than that. Okay, depending on when you're viewing this. The question here, though, is, can this be deducted as a medical expense? And we've kind of already, figured out that swimming pools, they potentially can be deducted. So Mrs. Ferris suffers from a degenerative spinal disorder, which was in 1970, causing her serious difficulty in walking or sitting. Her physician recommended that the Ferrises install a swimming pool in their residence, and that Mrs. Ferris use it twice a day for the rest of her life to prevent the onset of permanent paralysis. The Ferris residence was fairly described as a luxury residence with the highest quality materials and workmanship. So right now you're getting the view that, okay, $1 million, well, yeah, this is probably a mansion, right? A big mansion. The Ferrises, responding to the physician's suggestion, they basically got an architect firm. They created this 20 by 40 foot pool, hand-cut stone, Tudor-style semicircular ends, and a fountain. So this is a luxury pool, okay? So they're basically going overboard, okay, with this. And we already got that vibe with the fact they spent $1 million. Now, it's also recommended, the architect recommended, the housing structure and interior areas ought to be designed so as to use materials architecturally compatible with the main residence, which the house is a luxury house. The Ferrises agreed that the exterior to the addition was constructed of hand-cut, hand-laid stone. So they're basically using the same hand-cut, hand-laid stone of the actual residence. The interior featured more hand-cut stone for some walls, exposed cedar, cathedral ceiling, ceramic tile, all this really good luxury stuff. All of these features, needless to say, were costly. The architect also proposed, and the Ferrises accepted, inclusion in the structure of a number of recreational entertainment facilities, including a bar, cooking area, sauna, open terrace, raised dining area, indoor sunning area, dressing rooms. So this is, you're starting to get the vibe. This is like, wow, this is crazy, right? How can someone deduct this, right? And that's the thing. So here's some key information. The appraiser said that the pool increased the value of the home by $97,330. So they spent $194,660, and the value of the home increased by $97,330. Taxpayers claimed $172,160. So from what we've found, from what the law is currently, and this could have been different in 1971. You can't do that anymore, right? It's the difference. So at the minimum, or the maximum amount you can deduct would be $194,660 minus $97,000. So it's just under $100,000 they potentially could deduct. Well, they're taking $172,000 on their tax return. Okay, so that picture right there, to you in your mind, hey, that doesn't seem right. But again, it's possible the law back then was not as clear. Okay, but even then, there's issues because they're spending all this money. Maybe it cost them back then $40,000 to do a legitimate pool, but they're spending $194,000. They're spending $154,000 more because they want the marble, they want the hand-laid stone, right? They want the fountain, they want the spa, they want the outdoor dining area, they want all this stuff. Well, that's the real issue here. Okay, is there some type of limitation in terms of a luxury? So this is the Seventh Circuit. So the case started the tax court. In the proceedings of the tax court, the commissioner conceded that some sort of enclosure was medically necessary if Mrs. Ferris was to take twice daily swims during the winter. So recall that this is in Wisconsin, right? Brr, like it gets cold during the winter. You can't swim during the winter. So part of the pool, there had to be built an indoor facility, which that's pretty expensive. Okay. This is being recorded in Florida, and to have an indoor pool in Florida, that's kind of bizarre. I mean, it's possible. A lot of fancy hotels have it, but you still don't have it. Maybe in North Florida, but we just don't see that in Florida, right? But up there, it might be more common. Okay, so now you're starting to see why the cost might be as much. Okay, but the commissioner concedes that to be able to actually exercise in the pool, you do need an indoor facility during the winter, where in Wisconsin, 6 months during the year, it's too cold if your pool's outside. Okay, so that makes sense, and that should be part of it. That's basically what the commissioner is saying. The tax court found as a fact that no doubt a large portion of the total cost of the addition was attributable to the need of having the structure architecturally and aesthetically compatible with petitioner's residence, which is clearly a personal motivation. So the tax court is saying, look, they understand that a lot of this had to do with personal motivation, not the fact that the taxpayer that Mrs. Ferris actually needed create all this luxury for her medical issue, for therapy. The court rejected the commissioner's argument that the degree to which the addition's cost could be considered medical expenses, and be accordingly reduced, however, because it was aware no case limiting a medical expense. The court did agree with the commissioner that a reduction to account for enlarged size of the building due to clearly non-essential features of the addition was appropriate. So basically, you have the sauna and stuff. They didn't need that, so they're basically saying, okay. And the commissioners, you're going to see through a expert witness, said that this should be about $70,000. Okay, that's what the hypothetical cost should be. Commissioner's appealing. So basically, tax court's saying, okay, this should be allowed a deduction for $70,000. So now we have the Seventh Circuit come in and says the central question here is the degree to which the cost of the taxpayer's swimming pool addition was an expense for medical care. So basically they're saying, okay, we understand that there's an element of medical care here, but really what percentage of the $194,000 spent is actual medical care? Is it, what percentage of that? And can any be deducted? Can a partial amount be deducted? Can no amount? Because this is all just too lavish and you can't figure out what portion's what. Now, they cite the regulations, which we've already cited, and you'll see that it's pretty much intact. Same parts, the alleviation of a physical or mental defect, and then they also have both the part of regulations, which that's what we've already identified that's really quintessential to our analysis. So here's what the court's saying. This is really important. We believe, in light of the legislative history of Section 213 and the Secretary's regulations, that the tax court erred as a matter of law in rejecting the commissioner's argument that the substantial expense attributable to architectural and aesthetic compatibility was not incurred with primary purpose and related directly to medical care of Mrs. Ferris. So basically, the tax court didn't hold with the commissioner saying, okay, well, this is all just for personal aesthetic. The court here is saying that, yes, we do agree with the commissioner, so they're going to reverse what that court is basically saying. That's basically what's going on here. Section 213 allows for medical amounts We have no doubt the 89th Congress, which removed the ceiling on medical expenses, not to mention the average taxpayer, would be astounded to learn that this generosity allows deduction not only of a swimming pool and building to house it, but also a pool addition constructed in the grand and luxurious style employed here. That language is excellent. That's excellent language. This is not the law, where a taxpayer makes a capital expenditure that would qualify as being for medical care, but does so in a manner creating additional costs attributable to personal such motivations as architectural or aesthetically compatibility with the related property. The additional costs incurred are not expenses for medical care. It is no answer to say, as the tax court did, the taxpayers are not limited to choosing the cheapest form available to them. A taxpayer with the means and inclination to patronize a relatively expensive physician or to select a private room for his stay in a hospital would undoubtedly deduct more than his taxable income. But the facts remain, the taxpayer is incurring unquestionably to medical care. That cannot be said here. This is really good. Okay, this is really getting at this. Because if you recall from our fact pattern, boss is buying a luxury pool. Okay? So we need to bring attention to that. So usually, again, we usually start with some principle of law. But here, we want to bring attention. One issue involves boss's purchase of a luxury pool. And this is where we want to bring in the Ferris decision. So in Ferris, and this is where you want to summarize it, because obviously we can't just put all of that in the actual, we can't put everything in, that would make the memo so long. So and you just want to do the name, the title. In Ferris v. Commissioner, we're going to actually cite the reference later on. A taxpayer, an extravagant pool and pool house with a similar situation let's do the actual law, and then we'll come back and do application. So in Ferris v. Commissioner, a taxpayer purchased an extravagant pool and pool house after the taxpayer's physician advised the taxpayer to swim, we'll just call it swim therapy, do swim therapy twice a day for the rest of her life. And that's where we can cite this decision. And this is where we're going to go further. The court focus, and this is where we can bring in the wording if you want. Okay, and let's just make sure that we have the proper wording we want here. The task in cases like this is not one to determine a reasonable cost of functionally adequate pool or housing structure. Taxpayers may well decide to exceed that cost and construct a facility more in keeping with their taste, but any costs above necessary to produce a functionally adequate facility are not incurred for medical care. So I want to use that language right there because that's really good language. So we'll say the court focused on the court ruled that, and we'll paste that. Okay, we'll do the same citation again because that's from the case. Now, I'm just going to keep it basic here, but one thing you want to keep in mind in later, if you're going to go later research, is that when you're citing cases, you should probably cite the page number of the case. So if we look here, but I'm not going to do that just for the sake of time. If you look here, we can actually find the page number for the case. It's going to be the numbers pop up in the actual text. So we started, here we go, page 7850. 5, 6, 7, 8. Okay. Now my citation is a different format than this. It's the federal second. This is probably a West citation, probably a Westlaw citation. That's what they're using here. That's why it has a different citation for the page number. My page, you see, comes on the federal second supplement 1112. So 1100, page 1112. Okay. So that's not the same format, but again, I'm not using the things here. So I'm going to go back, and there's some other language that we read that was also there. Okay. So it may be possible to deduct from a taxpayer's actual cost of sum appropriate to the account for unnecessarily expensive building materials and methods and for a building size larger than needed. Okay. That's if it was allowed. That's basically what they're trying to stop here. Okay. I want to go back to this language right here. I think this last sentence really sums up really the highlighting parts. Okay. So where a taxpayer makes a capital expenditure that would qualify as being for medical care, but does so in a manner creating additional costs attributable, personal motivations as architectural, aesthetic compatibility, related property, the additional costs incurred are not expenses for medical care. And let's highlight that again. So that's really all we need, because that's really a rule of law. There's a difference between rule of law and dicta. That has actual rule of law. And it's really clear here because it actually says this is not the law. This is not the law. So they're interpreting this is not the law. That is law, versus dicta is usually a footnote or something that's just ancillary. Okay, so that's really what you can bring out of there. The commissioner's expert basically said that it was about $70,000, which is where that $70,000 amount came. And so what you see in this case, we emphasize in regard to the degree to which the minimum adequate facility would increase property value, while relevant to the tax court's analysis, is not relevant to deciding whether or not the luxury elements of a facility are taken for medical care. So I want to also highlight that, because it's saying here, this is really bringing this all together. We'll put that right after the last sentence, so right in the middle. Actually, just put that in the last sentence. Okay. Basically, the point here is that if it's so luxurious, the court might not even allow anything. Not just, the increase over value, but nothing. That's really what happened here. It was remanded. It was reversed and remanded back to the tax courts because it was a matter of fact, and the lowest level court, which here was a tax court, that should be the one that determines the facts. Okay. That's really what was going on here. So now after we have that, you want to bring attention. Boss purchased a luxury pool for $80,000. It is important that we find out more information about what exactly went into this luxury pool costs, okay? Because it's possible that, what is he calling a luxury pool? Is he saying, if it's heated pool, it's considered a luxury pool? If it's just a bigger pool, maybe he's used to small pools and he has a big pool. Maybe it's just a custom pool, because we're told from the facts that it's a big pool, or it's one pool, but it's a special lane. So we probably should bring attention to that. So he said it's important that we find out more information about what exactly went into, what exactly boss means by when saying a luxury pool. Is it heated? Is it rather large? Because the court in Ferris focused on materials, making the pool and pool house similar to the extravagant regular home, and other very factual items. So what it's possible that is it heated? Is it rather large? Is it considered custom? That might be what boss is getting at. Because if you think about a pool and you look at pool costs today, obviously it depends on where you're at, but $80,000, that doesn't seem like too extravagant, but it does seem maybe a little bit over maybe the average price of a pool. I mean, this is just for the pool. It's not for the pool house. We would be told about that if we did. Okay. So I'm just going to say, because in Ferris first commissioner, or because the court in Ferris focused, and this is actually, we need to make this, we need to make this an actual sentence. That was a fragment, right? Again, it's very important to look at, to obviously have good grammar and whatnot. This is, again, it's dealing with you, right? You have to make sure you have the paragraphs, and the margins and whatnot, everything. So last thing I want to look at, and that was that case, is, okay, so we're going to end where we started, which is looking at that private letter ruling. So this private letter ruling, I'm just going to summarize the facts for time's sake, but there was a son that was born, and he was born with a spinal cord defect, and basically the doctor said that he's going to need physical therapy when he gets older. And the best way to do it would be with a pool. Well, having the pool, it had to be heated at a certain temperature. Okay, so this actually might get at kind of what we're issuing. This might be considered a more luxury pool because it's a heated pool. Okay, so we can actually, and what you find is that this is actually allowed. It was only $16,000 in 1981, but when you adjust that for inflation, it's about $40,000 at the time this video is recorded. So there's two things that we're mainly focused on, and basically everything that we saw, it was allows a deduction to the extent it exceeds the value that increases. There was a few things that we're focused on. It didn't seem like it was too luxurious, based on the cost and the fact that the heated was needed. Okay, and maybe boss needs that as well. Maybe boss needs a heated pool. The other thing is that there was no pool near him, and that seemed to be a big focus. And that's something that's mentioned in our fact pattern as well. Okay, so boss recently, an automobile accident, 3 times a day, best therapy for his injuries. He lives in a very rural area. We're going to bring attention to that. And the closest non-private swimming pool is over an hour away. And by non-private, we're talking about like things where he can't sign up for membership like the YMCA or can't go to a public pool. He also can't travel for long periods of time. And actually, in the private letter ruling, it actually mentions this. Moreover, transportation problems would prevent your son from exercising frequently and independently in future in public pools. Okay, so that's obviously the thing. Okay, install a heated pool, can't travel to public pools because of a condition where he can't go far distance. Another thing that I want to mention is that in the Ferris case, and I'm not going to show that just for sake of time, and also in this private letter ruling, okay, it mentions that both taxpayers at issue needed this for the rest of their lives. Throughout his life, and also same with Mrs. Ferris. Okay, so you want to bring attention to that as well. You want to bring attention to these facts because it's very important. You might not have a solid answer here. You should probably give a recommendation for the partner to look over, but at least you're bringing a light to these certain things. So we're told that has to do swim therapy 3 times a day for the next several years. What is that? Is that 10? Is that 20 years? Maybe boss is only 60 years old, and maybe boss is only expected to live, so it could be for the rest of his life. And that would be like these other fact patterns. So let's bring attention to that as well, okay? So one thing we should mention is that in private letter ruling, we're going to say in letter ruling, that's how we cite that based on our citations. In letter ruling 821128, or I'm sorry, 8221128, the taxpayer needed a heated pool for his physical therapy. This was not viewed as too luxurious. So we're bringing attention to the fact that, hey, look, yeah, we have the Ferris case, which is a very big case, but that was extreme, okay? On the other end, though, we have, a very simple $40,000 in today, which is heated, okay? Is boss in the middle somewhere? Because if it is, we can try to make our situations more like the letter ruling, and maybe we can find some other cases out there. I'm just doing these cases because I'm showing you a major case here, and then we have a letter ruling to help you understand. This was not viewed as too luxurious, okay? And we want to cite the letter ruling. For disallowance. Okay, so that's where we just want to stop there, okay, with regard to Boss Ross, with respect to that luxurious issue. Now, Boss lives in a very rural area, so we want to first bring light to some other issues to mention, include, and here I would actually just do a bullet point, okay, and I would label the issues. Some other issues to mention include, okay. So we mentioned that using a public pool, because that seems to be something that's focused on. Boss lives in a very rural area, and the closest non-private swimming pool he can use is over away. He cannot travel for long periods of, due to his injury. So we start off by saying in letter ruling 8221128, the taxpayer could not travel to a public pool due to his injury. Let's rewrite that. So in letter ruling 8221128, the taxpayer cannot travel to a public pool. How about this? In letter ruling 8221128, because of the taxpayer's injury, the taxpayer could not travel long distances to the nearest public pool. The taxpayer was held to be allowed a deduction for the excess over the increase in value. Well, that's the general. We already know that from above. The taxpayer was held to be, how do we want to phrase this? To have a valid reason with regard to installing a pool. That's what we want to get at, okay? So now we can say boss. Boss lives in a very rural area, and we can say he cannot travel. Therefore, he will more likely than not. So that's the principle in tax. More likely than not, just so you know. But I know it sounds very wordy when we say more likely than not and then not, right? So what I like to do is I just say likely. He will likely be considered reason building the pool rather than going to a public pool. Okay, so the next one is amount of time needed in the pool, right? Because the idea here is, what if boss only needed it for 2 years for physical therapy, but guess what? Guess what happens? Comes around the corner and doesn't need it anymore. Will she still be able to get the deduction for this pool? Well, that seems a little crazy, right? So amount of time needed in the pool. Well, in Ferris, first commissioner, right? We're going to italicize that. That's a case. And letter ruling 8221128. The taxpayers needed the pool for the rest of their lives. Or I shouldn't say needed, right? Taxpayers were advised to use the pool for the rest of their lives. So the treatment, right? The pool therapy. Well, that's not what we have here. Boss is recommended swim therapy in a pool 3 times a day for the next several years. This could potentially be an issue. It is important that we consider how long is several years. Because if it's only for a year or 2, it's very likely that boss is not going to be able to deduct this. But if it's for many years and again goes for the rest of his life, then that's a big issue. If it is for a year or 2, then boss will likely not be able to deduct. They would say that's crazy. You're going to put in an $8,000 pool just for medical when you can just go, drive the hour or whatnot. I mean, I know it's hard for him, right? The facts are all based on one another, but why would you build $80,000? Is there some other form of physical therapy you can do? This would be the best one, but is it worth $80,000 to build the pool? Okay, there might be some type of personal motivating factor for the pool then. But if it's for a long time, possibly boss is older and could be for the rest of his life, then it's more likely that this issue will not be raised. So again, this is all about bringing up as many issues as you can to the partner, okay? Now we have to come up with a recommendation here, okay? So that's really all I think that you should focus on, because there's so many missing pieces of information, these facts, that I wouldn't go any further with the analysis. I mean, the heart of our memo is really those paragraphs, right? The general rule, the first few paragraphs. And I think that we did a good job with that portion of the memo. And then we leave some issues at the end. I always do that at the end, just in case there's some issues that you just want to address and you just bring them to the attention, okay? And you don't know how they're going to play in. Just always do it at the end because you want to bring everything else up front. So in our conclusion, the conclusion should be very short. So boss will more likely than not, this is where you should definitely use the language more likely than not, be able to deduct the cost of the pool if after getting more information, the pool is not considered too extravagant. Okay, we talked about extravagancy. It seems that it's medical, right? It's medical. We went through that, and that seems it's very likely it's medical treatment. And several years will be for a long enough duration that it will not raise any suspicions. Sorry, I shouldn't say suspicions. That's what we think, right? Will be for a long enough duration that it will not raise any issues. The amount that boss can deduct will be limited to 2 items. So first, consider in this order. So partners love when you do things, you tell them a specific order, like checklists and steps. They love that kind of stuff. They eat that stuff up. So the first thing we learned is that it's the cost of the pool, which is $80,000, minus the increase in value of the home due to the pool. Boss should get an appraisal. Okay, that's something that we should put in the conclusion. Okay, that's pretty evident from our discussion of the facts, and we might want to highlight that as well, where we talked about an appraisal would be helpful. So we did that. An appraisal of boss's home after the pool is installed would be helpful. See, this is like it's a continuous process. You're doing things as you're going and whatnot, and it's really good that we're going through this way, because you're seeing that it's not simply just, I work on one paragraph. That's not how this works. Okay, I'm telling you right now that it's not that simple. Okay, and the second thing is 10% of AGI, right? So the amount the boss can deduct will be limited to 2 items. Consider in this order. So the amount of number 1 minus 10% of AGI is a term, technical tax term that a partner would most likely know. So the item number 1, which we just calculated, right, cost of the pool, $80,000, minus the increase in the value of the home due to the pool, due to the installation of the pool. We'll make this sound as good as possible. Right? Boss should get an appraisal. I have that. Okay. Amount of number 1 minus 10% of AGI in the year of put installation of the pool. I think construction is a better word. So let's change installation to construction, because we're constructing this below ground, right? Construction of the pool. And that's really it. I mean, we've brought light to the fact that there's a few issues here, this luxurious whatnot, so we don't know 100%. But it seems very likely. This gives a very good estimate. Now the partner can go back and talk to boss about, okay, what do you mean exactly by a luxury pool? Why did you spend $80,000 over other pools? Does it have, special concrete? It's possible that it could be when you look at the value of the home. Maybe the value of the home is only $80,000 itself, and you build this $80,000 pool. It could be very extravagant when you look at everything. Okay, it doesn't need to be that much. And as we saw in Ferris, that was a huge issue. We also have to look at what exactly is several years. Will several years be a long enough duration that it will not raise any issues? The IRS won't bring anything? So that's really what doing a tax memo is all about. Again, we have to, the from, the facts, the issue, the analysis, the conclusion. Now, I wrote this a little longer. Some of the other issues mentioned include, you probably could get rid of that part, and you probably could just write a simple paragraph just addressing those as minor issues. However, I think it's important the way that we wrote that because we don't really have enough information to kind of address it like we did with Ferris, where we need the law. But that really is the way that I would approach that. All right, so I hope you enjoyed this discussion. I know it was a longer video, but again, it really helps you formulate how exactly to go through writing a memo when you have the various authority.